As we head into 2026, the stock market is expensive. Optimism is very high, and most investors are starting to get comfortable again. That's when people stop paying attention to price versus value. This is when mistakes start to happen. So in this video, I'm going to show you 3 stocks that could offer you real value right now, and 3 popular stocks that may be far riskier than they look and feel based on their current price movement. Because in markets like this, the price you pay matters more than ever. Right now, you cannot go online without seeing lists of stocks to buy. That's what happens when the market runs up. But here's the thing. Most of the time, it's the same companies on repeat. NVIDIA, Palantir, Microsoft, all these high-flying companies. For this video, we really did some digging. We're going to cover some companies you haven't seen all over the news, and surprisingly, a few you probably have. So listen, analysts are always making bold calls. The headlines appear confident, everyone sounds certain about what's coming next. But most of that noise is driven by short-term performance, not long-term value. And the reason being is these analysts have career risk. If they're sitting there saying these stocks that are flying high are not good buys, who's going to hire them? People are not going to give them their money. Banks are going to stop hiring them. They have career risk. That's why you should avoid looking at them. That's why we created this channel. And this is exactly why we approach all of this differently. We are never here to predict where the market will be in whatever period of time in the short run. And we're not going to chase what's already happened. We're here to look at a business, understand how they make money, and decide whether the price you're paying today makes sense for the value you're getting. We never want to pay when price is above value. We always want to pay the other way around. That is exactly how every successful, disciplined investor thinks, especially, and the hardest part is, when the market feels just a little too comfortable. So guys, as always, we're not telling you what to buy. We're not telling you what to avoid. What we did here is my analyst, Sam, in-house, without telling me, I don't even know what stocks these are. I'm going to find out with you here. He does the research on what analysts are talking about and not talking about. So it's all about teaching a process here. We're not here to literally say, go buy this and don't. We're here to teach a process. And if you're new to our channel, welcome. Just so you know, you're going to hear me say things that you've probably never heard on YouTube before. So let's start with our first stock to buy, Amazon. Now, according to analysts at Morningstar, Amazon is currently trading at a 12% discount to their price targets. Price targets are the stupidest thing I've ever heard of in my entire life. They have nothing to do with fundamentals. They're basically, where's the momentum going right now? Have you ever noticed that when a stock starts to go down, the price targets decrease? When a stock starts to go up, the price targets increase? But it's never about, hey, the company's doing better than expected fundamentally, and the future looks better. They expect both revenue and earnings to grow at more than 10% annually for the next 5 years, driven by improved efficiency and stronger profitability. And when you look at the business itself, Amazon is far more than just online shopping giant people know it as. They also have one of the strongest logistic networks in the world, and AWS, which is a highly profitable cloud computing business. Now listen, I can tell you better than anyone that for years, this is a very difficult business for me to understand. I was texting Dalton, our other analyst in-house this weekend. He's talking about Amazon. I said, yeah, I missed it on Amazon for so long. And he said, why do you think that is? I didn't understand their CapEx, and I didn't understand their gross margin. For the longest time, their gross margin was reported as 15 to 18%. Now, it's probably smarter to have it at the 50% margin. But as Amazon has scaled, it started cutting costs and improving its margins, which means more of its growth is showing up as cash flow. That cash flow is being spent on more growth. Jeff Bezos is a brilliant, brilliant CEO. He's no longer CEO, but he cared about 5 years from now. He has a great interview where he says, listen, I don't care about today. I care about 3 and 5 years from now. And I'm never asking what's going to change. I always ask what's going to stay the same. And he always said, people want faster and cheaper no matter what. So that combination of scale, strong cash flow, and steady growth, this is exactly why Amazon may be an attractive opportunity today. So let's run it through our process. So guys, Amazon is a $2.5 trillion company. That means if you bought all the shares outstanding and owned 100% of the company, if you were able to today, it would cost you $2.5 trillion. Now here's the interesting part. Their net income last year was $76 billion. Last 5 years was $37 billion. Look at their free cash flow. $10.5 billion in the last year, $8.5 billion in the last 5 years. Usually that's a red flag for me, but not with Amazon. Why? Because free cash flow is cash from operations less your capital expenditures. Look at their capital expenditures here. Let's go back to 2018 on capital expenditures. 13, 17, 40, 61, 64, 52, 83, 120 billion. Guys, they are spending almost 9 times more on capital expenditures today than they did in 2018. As long as they're spending it wisely and getting a high return on that money, they're going to do very, very well. That's a very important thing to consider about companies like this. If you cannot reinvest in your capital expenditures at high rates of return, you're destroying shareholder wealth. Guys, this is a lot of data. I'm looking at this and looking at the key metrics here, and it's a lot of stuff. It might feel overwhelming. You're not alone. I'm going to go through our analyst estimates and our 8 pillars. It's going to feel overwhelming. We're here to simplify all of this. It's been overwhelming for me at some point, and I had the luxury of building all this, but it took me a long time before I finally realized the things that I cared about. And guess what? This is going to change over time for me as well. But if you want an easy cheat sheet on all of this, if you want to be able to understand our videos better, and if you want to be smarter around your friends, click the link below. We will email this PDF to you absolutely free. It'll explain all of these metrics to you, why they're important, the full definition. Okay? So do that right away. Let's go to the 8 pillars here. All right, a lot of X's here. I think with Amazon, it doesn't matter. I'm not even looking at this. I know you might sit there and say, come on, Paul, really? Yeah, I'm really not. I couldn't care less. Their cash flows, it's all junk. It all doesn't mean anything to me because Amazon is not prime for today. They're always investing in the future. The question is, can they execute on that continuously? Analyst estimates, $8 a share in profit this year, growing to $14 in the next 3 years. So not a huge number, but a good growth. Revenue, look at this. 800 billion this year, growing to $1 trillion in the next 3 years, sorry. That's 11, 12, and 10% revenue growth. That's a lot. Now, guys, whenever I look at a company, I go through these key metrics and these 8 pillars and analyst estimates, but my main goal is to get right to Stock Analyzer tool first. Why? Amazon's selling at $233. If I run my assumptions for the future and it says the stock is worth 50 to me, and I'm just hypothetically saying that, why waste any more time? It's too far away. There are other people out there on YouTube who say, no, fall in love with the company first and then determine a price. I do not. I sit there and say, make reasonable assumptions about the future. And if you're close, go do more research. And what if Amazon comes in, it's worth 400 to my Stock Analyzer tool? You better believe I'm going to go do a ton of research on that. So Stock Analyzer tool is what we use to put the story and the numbers together. I happen to pull up Amazon the last time I did it in our software. I did a 10-year analysis, and you can do up to 20 years here. Revenue growth, first line, 4, 8, and 12% for the next 10 years. Okay. Profit margin. I did 8, 12, and 16. Now keep in mind, for both profit margin and free cash flow, I kept them the same, even though free cash flow is a lot lower. Over time, net income and free cash flow should equate out. But more importantly, look at my middle number, 12% here. They've never done that. In the last 10 years, they've never done that. I'm giving them a lot more value. I'm saying they're going to average a lot higher profit in the coming years than they've already done. Final, next 2 things. What PE and price to free cash flow would I assign to the company 10 years from now? Guys, the market average historically is 15 or 16. You go higher for a good company, lower for a bad one. I think we can all agree Amazon's a great company. So I'm going to go higher. I put 20, 23, and 26. If you think I'm too conservative, more power to you. If you think I'm being too aggressive, more power to you. That's what's great about having this, and this is why thousands of our users use this thing over 1 million times per year. It is so valuable to get you started. And finally, my 9% market return. This is my, what's the intrinsic value? What's the company worth? Not the price I'm paying, because I have no margin of safety in there, but what is it worth? I hit the analyze button. All my assumptions are in. I have a low price of 100, high price of 450, middle price of 226. So based on the current price today, if I bought it, I can expect about an 8.6% return if all my middle assumptions occur. That's what I'll make on my money. Is that enough? I don't know. But for me, it's probably enough to do some research on it. Now, before we go further, most investors lose money because they're only focused on trying to pick a winner, which is a stock that goes up in price. But I promise you the best investors do the opposite. They eliminate the losers first. That's by eliminating the companies that are going up in price when the fundamentals aren't as good. So let's get into our first stock to sell according to analysts. And again, it's the analysts saying this, not me. So guys, Intuitive Surgical is a very good business, But again, that doesn't make it a great investment at today's price. The stock is trading at a very high valuation relative to its current earnings and free cash flow, which means that the market is already pricing in the amazing growth potential that it could have. Now, while reading through articles, analysts called out significant downside on the stock. For those who don't know, ISRG dominates robotic-assisted surgery with its famous Da Vinci systems. It's a high-quality, capital-light business with a wide moat. What does capital-light mean? It means you don't have to spend a lot of money on capital expenditures. You saw on Amazon, there was tons of money in capital expenditures. Warehouses, cars, vans, all these things, robots. This company's capital light. That's great if you can find a great business that doesn't require a lot of capital. But the problem isn't the company, it's the price. So let's dive in. Can I tell you guys something? I was not expecting $205 billion market cap. I was not expecting that at all. Couple things. Free cash flow, $2.3 billion last year, $2.75 billion net income, five-year free cash flow. So their free cash flow is definitely lower than their net income. A lot of value investors wouldn't like that, but here's what I do like. Enterprise value and market cap. Enterprise value is lower than the market cap. That means they have more cash on hand than long-term debt. That's a great sign for a company. It's hard for companies. Imagine you had all the cash on your hand to pay off all the debts you have, car, house, student loans, everything with the cash in your bank account. What are the chances of going bankrupt? Very difficult, right? Great gross margin, 66%, and great bottom line margin and increasing. 10-year average profit margin, 26.7%. Last year, 28.6%. Now, it is selling for 90 times free cash flow and 75 times earnings. That's a lot. That's a lot. But let's continue on here with the 8 pillars. All right. Valuation bad, and low returns on capital. But here's the deal. It is getting better. Their 5-year return on capital is 7.5%. Their 1-year is 7.94%. I would have thought higher for such a low capital business. Return on equity is good. Return on assets is good. That one's kind of confusing for me. I don't know if I'm really worried about that, to be honest with you. But it is interesting. Okay, let's go look at analyst estimates. A lot of growth here, guys. Almost $10 a share this year, going to $17.60 over the next 4 years. 12.5, 15, 17% earnings growth. What have you heard so far that's not good? That's my point. I'm actually impressed that analysts were still negative on this because everything looks good so far. But again, price versus value. You've got to remember that when we're going through. And revenue growth, $11.6 billion to $18 billion over the next 4 years. 15, 13.5, 11, 10, 12.25% revenue growth. Pretty solid growth, guys. So it looks like this company is not going away right now. So guys, what is the right price to pay for the stock? Well, I don't think I've ever done this stock before. So let's take a look. Let's see if I've ever done it. No. So we're going to watch me make my assumptions of this company going forward. Here's what I'm going to do. So let's go pop my cherry on this company. So revenue growth, I'm going to do 5, 8, and 11% revenue growth. A lot lower than analysts expect for the next 4 years. But remember, we're going out 10 years here. Okay. Profit margin, very consistent. I'm going to do 26, 28, and 30. Free cash flow margin, I'm going to keep it the same. But wait a second. Why is that? Actually, let's go back and look at their free cash flow here because this is confusing to me. Capital expenditures. Oh, okay. So here's what happened. Here's what I'm seeing that's confusing here. Capital expenditures were 340, 530, $1 billion, $1.1 billion, and now $690 million. So it's all over the place here. Let's see what their last 1-year free cash flow number is, because that's going to matter. So if you look right here, their 1-year free cash flow is a lot closer. So here's what I'm going to do. I'm going to do 20, 23, and 26. Now, what PE would I put for this company 10 years down the road? Remember, not great returns on capital, little unknown, but it has a wide moat. So I'm going to go with 15, 18, and 21. And then finally, my 9% desired return. Now, guys, remember, I'm making quick assumptions here. The stock's selling for $565. I hit the analyze button. Okay. Low price of 95 to 125, high price of 240 to 280, middle price of 150 to 190. So let's go back to the top and see. Let's see if I change this to 7, 11, and 15% revenue growth. How much does that change the stock? Not by much. 100 to 140, low side 330 to 380, high side 190 to 230. It's still not a good purchase, in my opinion. So I don't disagree with analysts here. I would be avoiding this stock based on these valuations unless there was some other information I don't know that greatly changes the numbers above. Now, guys, stock number 2 to buy is Campbell's, and I'm sure you guys recognize this brand immensely. But analysts from Morningstar have this stock as one of the best value opportunities in 2026 with significant upside and a very wide moat. This is not a flashy stock, and that's exactly why it's interesting. It's immediately why I'm interested. Campbell's operates in a defensive part of the market where demand stays steady despite the economy. Campbell's owns well-known brands across soup, snacks, and packaged foods, all of which show up in households year after year after year. So let's check out why this one stock has not only analyst attention, but members of our community as well. So this is the right ticker up here, CPB. It's an $8 billion company. And guys, first thing that jumps out at me, enterprise value of 19 billion. That's $11 billion in net debt. And guys, their cash flow last year was $687 million, down from their 5-year average of 760. But it's still a lot of debt for that little cash flow. Now, it's a very secure brand, and people in our community have an average buy of it right now, rating of a buy at $37 per share. Okay, so that's interesting to see. 30% gross margin. Now, guys, look at this dividend. 5.6%. That's a big dividend yield for the next year. 5.6%. Now, at the end, with Stock Analyzer, you don't add that dividend yield to the returns. It's included in that return. But that's a big dividend, which a lot of people love. And from the looks of it, it's probably pretty secure because it didn't eat up a ton of their free cash flow. But what else are they going to do? Now, here's what's interesting. 12 times free cash flow, 14 times earnings. Okay. My comment to the company is buy back your shares. Get rid of this dividend and start buying back your shares. Why are you doing this? 8 pillars. They've bought back 1.3% of their shares. Why? Their debt levels are high, like I said. Cash flow is down. Net income is down. Returns on capital are getting better. Actually, not getting better. They're barely above our metric. Okay, this is a company that has a great brand, great moat, but the financials of it are making me feel a little icky inside. Like I wouldn't want to buy a company. I wouldn't want to own. If I were to go buy this company in full, one of the things I'd want to do is say, okay, what price can I pay to eliminate the majority of that debt? I don't want that kind of debt overloading the company. It's not it's a decent, but look at these margins. They're getting lower and lower. 10-year profit margin, 8.7, 5-year, 7.8, 7.9, 1-year, 5.7. Okay, that's a red flag for me. Let's see what analysts think about the profit. $250 a share going to $361 over the next 4 years. That's a big drop this year and then growing reasonable. And then revenue growth, I was going to say it's going to be very small. 1%, 1%, 3%, 1%. This is not a sexy company, but remember, that's okay. In fact, that's what we want because we want to sit there and determine, is the market overlooking this because it's not fun? So let's go to a Stock Analyzer tool. And let's see if I've ever done this company before. Are we going to chop it? Are we going to pop another cherry for me? We've done it one time years ago. So I'm just going to do it again on my own. Revenue growth. I'm going to do 1, 3, and 5%. Profit margin. Boy, I don't like this declining profit margin. I'm going to go 6, 8, and 10. No, I'm going to go 6, 7.5, and 9. Same. I'm going to do cash flow of 6, 8, and 10. Now, what PE and what price of free cash flow 10 years from now? Low returns on capital, getting worse. Margins getting worse. It is a great brand. So I'm actually going to do 13, 16, and 19. Now, you might wonder, why is that? Well, because if they do this, I'm okay giving them 16, about the market average. Yes, it's a moat, but it's got these declining returns on capital. I don't really like that very much. And not a lot of growth rate and a lot of debt. I can understand going lower than these, to be honest with you. And finally, my 9% market return. Hit the analyze button. Okay, this is why it's interesting to people. 25 on the low side, 63 to 70 on the high side, 40 to 43 in the middle. Remember, these returns include the dividend in there. So for me, I'm going to be honest with you, my opinion is I just worry about that debt level. Like, why have $11 billion of debt when you're generating $700 or $800 million a year in free cash flow? I get it. Debt's a great way to magnify your returns, and this is a company that does well, probably even better during bad times. So I'm stuck on this one. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. Now, guys, this next company, Tesla, and I'm actually surprised because it's listed as a sell. UBS analyst Joseph Spack recently reiterated a sell rating on Tesla and maintained a $247 price target, which implies almost 50% downside from current levels. He also lowered Tesla's Q4 delivery estimates, citing weaker demand after losing federal tax credits. From a business standpoint, Tesla is still a leader in electric vehicles, but the competitive landscape has changed dramatically. A few years back, when Tesla was at its first all-time highs, like it is now, I repeatedly made it clear that I thought we might look up in 10 years, and ready for this one? Tesla will still be trading at the same or lower price than today. You can go back and check the videos. I have no problem standing by that. Nearly 5 years later, and shares are up just about flat over that time. That's why the price you pay is so important. And I still think, based on today, going forward the next 10 years, I still believe Tesla will be priced lower than it is today. Now, Tesla at the 2022 lows of 100, very different investment than that at 435. That's the key there that I want you to understand. But Tesla is a car company. A small portion of people watching this video right now are shaking, going, it's not a car company, Paul. It's more than a car company. Well, if 95% of the things I say are asshole comments, what does that make me? Say it out loud, folks. It makes me an asshole. If 95% of the things I eat are junk food, what does it make my eating habits? Junk food. If 95% of the revenue that comes out of this company is based on cars, what does it make this car company? Oops, I slept. It's a car company. Doesn't mean the future can't change. But as of right now, all the revenue is coming from cars. And for a while, it was about software. Then software was a colossal failure. Then it was about robots. Whatever the next thing is, it's always about the next thing with Tesla. And I want you to keep in mind, I like Elon Musk. He's brilliant. I hate the people who have Teslas who have the bumper sticker that says, I bought this before Elon Musk went crazy. No, you bought it when you thought Elon Musk was a left-wing psychopath like you. Now, when people realize he wasn't that, they all of a sudden say, oh, he's crazy. No, he was always crazy. That's what it takes to be worth $700 billion and at the ripe age of 54, or whatever he is. Tesla is selling for $1.6 trillion with $95 billion in revenue. BYD, the China electric maker, just passed Tesla this past weekend to be the #1 electric vehicle seller in the world. Net income, $5 billion. Cash flow, 6.8. PE, 316. Price of free cash flow, 235. Margin, 5.3. Gross margin, 17. Do you know who else has these margins? Every other car company in the world. Price to sales ratio, 17. Every other car company, 0.5 to 1. Guys, Microsoft, a software business, isn't selling for 17 times sales. I just don't get this. And I could look back on this and go, oops, I made a mistake, but this one's crazy to me. Let's go look. It's a strong sell rating by our community members. 8 pillars. I mean, obviously cash flow's up, net income's up, revenue's up, lower debt levels, which is good, but everything else, the shares outstanding isn't bad. 4.6% dilution for a company that's overvalued. If I was Elon Musk, I'd be issuing shares like crazy. I'd be like, yeah, who wants shares? You want shares? Let's go. Let's get some cash up in this bitch. Analyst estimates. We have look at this, big time growth here. 214 per share to 873 per share. Let's say, guys, that this company justifies 30 times earnings, which is a big number. 3 years from now, that takes the company to $260 a share. It's currently at $450. It's kind of tough to justify that. Could be better. Revenue growth going from $110 billion this year to $217. That's 13, 17, 24, and 35% growth in their revenue. So guys, what's the stock worth? Let's pull up our stock analyzer tool. Now, going back to what I said earlier, the company is currently a car company. It doesn't mean there isn't a value to the things they're working on, but you can't treat the robotics business as a full business when it's not generating big chunks of money. You cannot do that. So guys, I made some very aggressive assumptions for the next 10 years. 10, 15, 20% revenue growth. Profit margin, 8, 12, and 16. Guys, they've only done over 8 one time, and they've never done 12 to 16. I am giving them massive potential in their profit. I'm assuming they become more than a car company here because their current gross margin, every car they sell, they make 17% on it. I'm talking about the bottom line being 12% and the high side 16%. What that means is for this to happen, they have to be more than a car company. PE, 20, 25, and 30. Absurd. 9% return. The stock's currently at 450, even with my absurd assumptions. Look at this. Low price of 68, high price of 405, middle price of 180. Let me show you what I really think of the company. I really believe it's going to be this. 7, 11, 15, 4, 6.5, 9 for the margin. 15, 18, and 21 for the earnings multiple. And I really believe the stock is worth this. 22 on the low side, 116 on the high side, 55 in the middle. I know every Tesla bull in the world is crying right now and cursing me and flicking me off. Guys, it's just math to me. I could be wrong on these assumptions, but even when I went aggressive, it doesn't even get close to the price it's selling for right now. If you think Tesla's a buy right now, you probably care more about price movement and story than you do about fundamentals. I'm sorry. All right, our final stock to buy is Clorox. Now, Clorox is another example of a company that doesn't get much attention when markets are focused on growth and excitement. After dealing with cost pressure and operational challenges over the past few years, expectations around Clorox are very low. Analysts estimate a near 50% upside, setting their 4.7% dividend in a very wide moat. From a business standpoint, Clorox owns a wide range of household cleaning brands. This is a classic example of a boring, durable business where patience and reasonable pricing could work in an investor's favor. Now, guys, remember, I talk about Clorox all the time. I remember during COVID, we made videos and said, guys, it's soaring, but this is not a permanent. I didn't think it was a permanent thing, just like Pfizer. I was like, listen, this is a temporary surge. What did it hit? It hit $239 per share, almost $240 back in August of 2020. This past 2 weeks ago, it was a low of $96, and it's currently at $100. Again, we talked about the dividend, but here's the deal, guys. Look at this dividend. It eats up $600 million of their cash flow. That's all their cash flow. It's 100% of it. So I look at this going, okay, the dividend might be just alluring to get people to buy the stock, but this dividend is not very reliable, in my opinion. Good things, though. Boring companies with high returns on capital. Not very capital intensive, not much in acquisitions, very boring revenue growth. But remember, this is coming off COVID, so that's why revenue is probably lower. But look at the 10-year growth rate on revenue, 1.75%. Snooze alert. So I look at this going, all right, wow, look at this. So 10-year profit margins, 9.5%. 1 year is 11.7. 5 years, 5.84. All right. A good amount of debt here, actually. Let's look at the 8 pillars. Let's see what's going on here. The debt, okay, it seems reasonable. But remember, they're also eating up all their cash flow with that dividend. Great returns on capital, bad PE, bad price to free cash flow. And their 5-year free cash flow is higher than their 5-year net income, but their 1-year net income is higher than their 1-year free cash flow. Let's see what analysts think here, because I'm really perplexed about this one. Oh, wow. Actually, pretty decent growth. $6 a share, growing to $8.35 in earnings per share, and revenue growing 3-4% a year. All right. So, stock analyzer tool. Let's see if I probably did this back in 2020. Oh, 2023. Okay, so I'm going to do my 9% returns here. Hybrid. Okay, so I did 0, 2, and 4% revenue growth for the next 10 years. I did profit margins of 8, 9.5, and 11, and free cash flow. I'm actually going to change this free cash flow to match. Now, PE. So it's a moat business. We all know Clorox. It's got high returns on capital. It seems to be getting better, but there's no growth here. I did 13, 16, and 19. Is that too low? I don't know. Maybe. Is it too high? I don't think it's too high, but maybe it's too low. But again, my 9% return, $100 current price, hit the analyze button. Boom. So I actually disagree with this. Low of 50, high of 115, middle price of 77. Even with the dividend, you're looking at a 5.38% discounted cash flow return. Yeah, this isn't exciting to me. I'm actually probably wanting to wait till it gets to the low price or lower because I have to make the money. I mean, this thing is blah. Yeah, it's got high returns on capital, but how do I make my money off this company? I got to buy it dirt cheap. I think there are much better options out there. And this is why we don't blindly follow analysts when they say 50% upside. Guys, an analyst could be sitting here, Warren Buffett could be sitting here right now and saying, Paul, you're missing out. Just like he had Verizon for a while. I remember saying in a video once before, I'm like, why does he have Verizon? I don't get the stock. Like, I would not buy this. I'm not saying I'm better than Warren Buffett. What I'm trying to say is this is how confident I want you to get in investing, where you can have somebody look at a company, look at the numbers and say, this analyst on Wall Street is saying 50% upside. And I say, I don't see it. But everybody has a different look. Now, our final stock to sell, according to analysts, Walmart, which is right now a strong sell by several seeking alpha analysts. They cite extreme overvaluation relative to its growth. Now, you may not realize it, but Walmart is trading at historically high levels, a PE close to 40x. Let's see where it's at right now. Yeah, 39.44, which is unusual for a slow growth retailer. What makes this more concerning is that Walmart's valuation now exceeds peers like Target and, guys, even Amazon. Think about that for just 1 second. So the math to me probably doesn't work. Its earnings yield sits well below risk-free treasuries, and this setup looks oddly similar to Walmart's overvaluation during the early 2000s tech boom, when the stock peaked and then went nowhere for a decade. Great company, zero question at that. But at this price, the risk of poor returns may be a bit high. Now, guys, it's almost $1 trillion market cap business today, $900 billion, revenue of $700 billion, dividend yield 0.81%, their cash flow $15 billion relative to income of $23 billion. It's been pretty stagnant for a while. Now, guys, here's the thing that perplexes a lot of people. Look at these profit margins. Last year, 3.26, 5-year, 2.38, 10-year, 2.45. People think this company prints money. On $700 billion in revenue, it only generates $22 billion in net income and $15 billion in free cash flow. Return on capital, nothing to write home about, but reasonable debt levels, especially for a company with so much retail. Our community members have it as a sell. So let's continue on with this one, the 8 pillars. All right, lower free cash flow, higher debt levels. I think that's understandable. But man, look at these 5-year PE and 5-year price of free cash flow. Insane. 60 and 65. That's a lot. Let's see what analysts think about this. I mean, okay, so we have 5%, 12%, 13%, 9%, and 3% earnings per share growth. So not bad. It's a big company. And then revenue growth, 4 or 5%. Yeah, makes sense. It's Walmart. They're going to open a few stores. Their prices are going to go up with inflation. So 3 or 4% seems about right. So let's put it in our stock analyzer tool and see what I've done in the past here, because I just did it back in December. We do so many stocks, I don't even remember doing it in December. So I did 2.5%, 3.5%, and 4.5% revenue growth the next 10 years. I did profit margin of 2, 2.5, and 3, and free cash flow of a little bit higher, but I should probably just make it the exact same free cash flow levels. So 2, 2.5, and 3. PE, now decent returns on capital, but it is Walmart. It's huge. They're expanding their online. So I did 17, 20, and 23. I gave them more of a benefit than other companies, and a 9% desired return. Hit the analyze button. The stock's currently at, whoa, look at this. I have a low price of 28, high price of 60, middle price of 40, negative 3% discounted cash flow return. Guys, I agree with analysts here. I do agree that I would not be buying Walmart anywhere close to this. So let's bring this all together. You can own incredible companies and still lose money if you overpay. You can buy boring companies, overlook businesses, and do very, very well if you stick with it. That's the difference between speculation and investing. So as we go into 2026, expectations are high, and mistakes will be punished at some point. This is when having a process matters the most, focusing on fundamentals, demanding a margin of safety, and being willing to wait. Trust me, guys, you don't need to be flashy to build wealth. You need to be consistent, logical, and prepared. That's how real investors win cycle after cycle. So if you want to learn the exact detailed process that I use to determine the right stocks to buy and the price to pay for them, click on the video right here for our full course. I'll see you there. Thank you for your time.